Welcome to the Zandbergen Report, where wealth strategies and pop culture collide, featuring your distinguished host and certified financial planner, Bart Zandbergen.
Welcome to our show of Dream Chasers and Wealth Makers. We are thrilled to be back in the studio today with a new episode of the Zandbergen Report. I'm proud to bring in the movers, shakers, and difference makers who are passionate about sharing what they have learned and what you need to know today. Hello and welcome to the show. Today I am pleased to have with me my friend and fellow advisor, Scott Heinila, all the way from Dallas, Texas. Scott, thanks for joining me.
Hello. Thank you for having me. It's good to be here on the
Zandbergen
Report.
We're going to have some fun.
As always.
Okay. So we are going to discuss the best that we can, a review of 2022, the highs and the lows, and then also the best that we can, what we're expecting for 2023. How do you feel about that?
I'm ready to dive in, sir.
All right.
It's interesting times, not just that 2023 threw all kinds of things at us and investors at large, but 2023 is looking to be quite the whipsaw.
Yes, this is true. This is true. And before we get too far into it, Scott, I'm gonna challenge you. We're gonna do a little brain quiz. I want to get you really ready for the show. So, are you prepared? You ready?
We'll see. Let's see what the results will be in a minute.
So every year, dictionaries name a word of the year. Some select the word that is most frequently searched. Others put it to a vote. So, Scott, which of these was not among the top contenders for Merriam-Webster's 2022 word of the year? Here they are: Loamy, L-O-A-M-Y, gaslighting, goblin mode, or oligarch. Which one was not?
Which word was not? Okay.
Yeah.
We're going to remove oligarch from that.
Okay.
That was definitely in the news. Was it Loamy?
It was not. I literally, other than oligarch, had to look up every word. So apparently we're not in the cool crowd, not knowing all those words are. But goblin did not make the Merriam-Webster shortlist, but it did. It was on the Oxford Languages Word of the Year. Here's what it means, in case you don't know, because I didn't. A type of behavior which is unapologetically self-indulgent, lazy, slovenly, or greedy, typically in a way that rejects social norms or expectations.
And that was the word that was not?
Yes.
Interesting.
So Webster's word of the year was gaslighting, which I had heard but didn't know what it means. And so that's my knowledge, limited knowledge. And it is the, do you know what it is?
I do, but go ahead for our audience. Yeah, absolutely. It's
okay.
Adding fuel to the fire, so to speak.
The act or practice of grossly misleading someone, especially for one's own advantage.
Mm-hmm.
All right. I'm not done, Scott. We've got more. We have got more. All right. Obviously, the pandemic shaped the way what people do and the way people eat. And so with time on their hands, many people taught themselves how to cook. And matter of fact, they spent a lot less money on food during that time period. So in 2022, more people searched for one recipe than any other. Here's the list. Tell me which one you think they did. Cincinnati chili, Marry Me chicken, Sugo, S-U-G-O, or mango pie.
Wait, so Sugo and mango pie are separate?
Yes, they are.
Okay, I have no idea what Sugo is. I would definitely exclude Cincinnati soup or chili soup.
Chili, yeah.
The Lugo would be
Sugo.
too easy. Sugo.
Yeah.
What was the second one?
Marry Me chicken.
Okay, I'm going to go with Marry Me chicken.
Okay. As a sidebar, Tina called it engagement chicken, and she, 2 weeks into our relationship, she made me engagement chicken, and 19 years later, here we are. But that's not the answer. The answer is Sugo.
Oh my! What in
Here's
the
what it
heck
is:
is Sugo?
a legendary tomato-based Italian sauce that's made by cooking tomatoes with onions, garlic, seasoning, and extra virgin olive oil. That
Okay,
sounds
it sounds wonderful.
like good tomato sauce. All right. Anyway, you feel warmed up? How's your brain?
Exercised. Let's continue pressing forward.
Excellent. Okay. So let's talk about, first of all, 2022 in general. As we know, let's just call it a terrible year for both stocks and bonds. If you average the different stock indexes, S&P 500, MSCI, which represents global stock index, NASDAQ, et cetera, you're down about 25% in a straight, if you average those stocks. Probably more disturbing is that the bond index, as measured by the bond aggregate, AGG, was down about 15%. Only one time in the last 45 years have both stocks and bonds been down at the same time. So that's what created some unhappiness, I think, in 2022 from an investment standpoint. As a side, the way you and I manage money, it's good news that we use things other than stocks and bonds that have really helped our portfolios, and in some cases, something near and dear to your heart, like fixed annuities and things like that. So we had that going for us.
Yeah, and other private alternative investments as well that aren't affected by the public markets, which certainly had an impact in 2022 for sure.
Yeah, for sure.
Mm-hmm.
But if we dig down a little bit deeper, so what was causing some of this turbulence? Well, we had uncertainty about the Federal Reserve hikes, and that was a pretty significant hike in rates. War in Ukraine, COVID-19, rears its ugly head again in China, labor shortage, and then of course inflation. So if you add all those things, a lot of uncertainty, and of course the direct, or if you will, indirect relationship between the rise in interest rates and the value of bonds. Many people don't know it's just a straight math equation. If interest rates go up, value of bonds go down. So clearly, if we look at, treasuries a year ago were like about roughly 0.17. And if we look at the 10-year today at hovering around 4, somewhere thereabouts, that's a pretty significant increase.
Yeah, I'll add to that, and something maybe we can set aside and revisit before we convene, but also when you look at 2022 and just from an equity standpoint, which sectors were impacted the most, and certainly the gem of the bunch, which is the tech sector as a whole, previous to 2022 has done incredibly well for the previous decade, right? And when you look at 2022 in particular, it was one of these sectors that was impacted most, and is currently dealing with a lot of adjustment.
Yeah, I think you hit a good point. We've had about 10 years of very solid, what we would call growth, the growth sector of the stock market. And those would be, primarily tech, stocks that do not pay a dividend, stocks that typically do, and this is going to be related, stocks that do typically rely on interest rates and financing for growth. Therefore, when interest rates go up, cost of borrowing is more expensive. So as a whole, that group, if we just name a few, like the Amazons and companies like that, good companies that got hit pretty hard that are in that category. The flip side, and just to play on the rest of your statement, if you look at companies or ETFs or funds that focus on large U.S. dividend-paying stocks, think of IBM, Procter & Gamble, Home Depot. These are not recommendations. These are just examples. Held up, they were down, for the year, but comparatively speaking, held up quite well.
Correct. Significantly more resilient than that of their technology peers. And, you had some very unique circumstances and activity in technology stocks. You mentioned Amazon, but you've got also some very, what I call, napkin, a cocktail party stocks, like a Tesla, Zoom, Peloton. Just to put out some different names of, of investments that individuals were, I think, very, very, migrating towards from a sexy standpoint, and did incredibly well during COVID. And then as things adjusted and the economy pivoted and opened up again, and your point, interest rates, well, those stocks and those particular investments were impacted significantly, as opposed to the 3Ms of the world and companies that are just very, very stable dividend paying companies, your blue chip companies that just weathered the storm significantly better than the others.
Yeah, that's for sure. If we could dissect each of those different areas. Inflation, let's play both good and bad. The good news on inflation is we have seen it start to ease. Here in the U.S., it was up as high as near 9% or thereabouts at the max in 2022, and I think we're hovering in the fives right now. So that's some nice softening. But I think more importantly or significantly internationally, there's some countries like Venezuela, 73%, Turkey, 154%. There was some significant inflation impact. And of course, part of that, I think, is on their ability to get natural resources. The war of Russia and Ukraine affects certain countries differently. So that certainly had an impact and will continue on international investing.
You look at, so I question, from that perspective, 2023 and 2024, are those countries now more stabilized than they were in 2022, or do we foresee continued headwinds and significant inflation outside of the U.S.?
The correct answer is nobody knows for sure. So let's start there. But if we're looking for an opinion, my opinion is I think there's still going to be some strong headwinds in non-U.S. countries, specifically probably in Europe.
Right.
We as a firm have really reduced our exposure to those type of areas. But I will say, under the same breath, we still do have exposure internationally. And as you know, we do what was called the bottom-up approach, which is we are first of all looking for great companies, almost regardless of where they're established and if they're or domiciled, and if they're multinational, they're doing business outside of whatever country they're in. And there are plenty of examples of countries that are in Europe that do most of their business outside of Europe, and the companies are doing great. They're
Right.
deemed international companies, but they are multinational in the way that they do business.
Makes perfect sense. Moving on.
All right, so we covered inflation. Not everything is terrible, right? Job growth was strong. Matter of fact, it was the second best year for job creation since 1939. So it seems a bit contrary to everything, given everything else that was going on. But that's the statistic for 2022. And then we just saw unemployment numbers come in at about 3.7. So from that standpoint, things look pretty good.
Well, with the recent jobs report, right, it was over 500,000 new jobs were created in the quarter when, correct me if I'm wrong, but I think the expectations were somewhere in the 180 or 170,000 range. So there's where I bring in this comment of whipsaw. If expectations are X and employment numbers are coming significantly greater, wouldn't that indicate that we're not done yet with this inflation conversation? And then conversely, you've got the Fed only raising rates 25 basis points, which created the market to just go on a tear in the short term. And so, you've got these conflicting metrics that are coming at us currently. And there's where there's still, although stability, you question what does the rest of 2023 in the future bring?
Yeah, I think we're getting close to kind of talking about that, but you bring up a good point. And one of my favorite quotes is actually, "It's tough to make predictions, especially about the future," and that was Yogi Berra. A little bit of comedy there. Thanks for laughing. Another kind of abnormality is of the whole situation is that real personal income actually increased. I guess maybe it's not that abnormal if you just look at classic economics. Unemployment was low, the labor supply was limited, so employees were able to negotiate better wages, with the real income increase of about 1.4%. So that's after inflation, 1.4. So that's kind of an interesting fact, I think. And then somewhat connected to that, not only was personal income increased, but so did spending. People were going on trips. People were buying cars, light trucks. They spent money on healthcare, food, accommodations. So spending began to slow down a bit in the fourth quarter, to your point. So, what does that mean for 2023? But I found it interesting with everything going on that was still considered high.
Yeah, a lot of that I would say is probably driven just by the fact that people have surplus capital from the COVID and the money supply that was provided through COVID, and so they're still living off the cash in their savings account or their checking account, and consumers were out spending. Well, another question I don't expect to answer right now, but what does now when that money runs out, what happens?
Yeah, right. Those are great questions. Let's take a look at housing. So home prices, but in Q4 we started to see things cool off just a bit. So housing prices as of October of 22 were up 9.2% year over year, but down 2.7 over the previous 3 months. So, still up, but definitely a cooling. And then apartment rental income was down 2.2 for the previous 3 months in October 2022. And I think
which is, I mean, the reality, everybody wants things to only go up, but some pullback, certainly in the real estate market, is a very, very healthy thing overall. So that's a good sign. I think it's important that people understand that.
Yeah. And, I think we just, to a sense, we do need to be logical as well. And if you use classic economics and a little bit of logic, for those who are financing a purchase of a home, a year ago, roughly you could get 3% or sub 3% on a 30-year mortgage. And now there's 6 point something. That's double the interest rate. That means the affordability of, X price home is going to be significantly less for the buyer. That's good. That's destined to bring prices down.
Well, 100%. I mean, and that's the part that I think just maybe many people don't necessarily take into account is how significant of an impact a rise in interest rates have on the affordability of that home. Because for most consumers, what does it come down to? Not necessarily the price of the home, but what the monthly payment is and what I can actually support based on my income.
Yeah.
I mean, you run some basic numbers of just the difference. Let's take a $500,000 mortgage, which, to be honest, in Southern California, you're going to be hard to find.
Sure.
And if interest rates are at 6.5%, your mortgage payment is roughly $3,300 a month. If I was to use the most extreme example of when interest rates really bottomed, which was, let's call it 2.75%, you're cutting $1,000 or $1,200 off of that mortgage payment. That's real money.
Yeah.
You double that if your loan is $1 million, right? You're talking $2,400 a month, $2,000 a month. That is significantly different and has a direct consequence on the affordability and in turn the pricing of real estate.
Yeah. And this is I just happened to find this related quote from David Kelly, chief strategist for JP Morgan. He says, "For many people, I suspect 2022 will be a year to forget. However, for millions of home builders, home sellers, and home buyers, it will be remembered for the speed with which a housing boom turned into a housing bust." And that, of course, is attributable to the surge in mortgage rates.
Mm-hmm.
I think go ahead. No, I'm about ready to switch and maybe look forward a little bit more. So you go ahead.
I was going to say, that's very well said and articulated.
Well, thank you, Scott.
Yes. Not you, what he said. by
David
the way.
Kelly. Well, okay. Well, I'll get all right. No credit for reading. No reading. Like, wow. I thought it was quite articulate. You know, getting back to that funny quote about prediction, there are predictions, forecasts that will support about anything that's out there right now. There's 30. I'm reading something from Goldman Sachs, a 35% chance of a soft landing in 2023. Bank of America survey, 92% of asset managers participating in survey are expecting higher inflation in 2023. That's probably kind of a no-brainer. And then 63% chance of a recession in 2023. Recession, soft landing, those are somewhat connected. You could have a recession and still have a soft landing. But the point is, nobody knows, right, for sure. And regardless of whether they know or not, we just need to stick to our plan, do what we should do, be
That's right.
financially secure with what we're doing.
And I would add to that understanding that this situation is historically fluid, right? I mean, this whole term of soft landing and navigating interest rates with the money supply and the economic and global circumstances that are surrounding all of these parameters, this is a very, very fluid situation. So even more to the point of just of being aware and sticking to the plan, and staying the course, I think is more important than ever.
Right. I think it's also important to note, and you and I, we have talked about this all the time, but recession creates kind of an ugly feeling in most people, and oh no, what's going to happen in my portfolio? But let us keep in mind that the stock market is, economically speaking, a leading indicator with the economy and recessionary periods. Meaning, we just had a bear market, we don't know now. We've had a great month in January, but we had a bear market in 2022. And we have not yet been deemed to be in a recession. So let's just assume that is going to be stated here at some point soon. The stock market has led us into that recession and will be the first to lead us out. So, hypothetically, we could be announced that we're in a recession and we could see the stock market continue to do nothing but go up. So interesting fact that just because we're in a recession does not mean the portfolio is going to suffer.
Correct.
Somewhat related to that, if we look at yields, and I mentioned treasuries earlier on, we are in what's known as an inverted yield curve, which means we are receiving higher rates of return on the shorter durations versus the longer. Now, every recession has had an inverted yield curve, but not every inverted yield curve leads to a recession. So there's really not much probably maybe value about that, other than the fact that just because we are in the inverted yield curve situation now, that does not guarantee that we're going to be in a recession.
Right.
But we are enjoying those short-term yields right now, I must say.
Absolutely. I mean, to be able to get close to or in excess of 4% for something with a maturity date of less than 12 months is I mean, historically speaking, when have we seen that?
That's right. Exactly right. So getting back to that statement regarding the different forecasts, the different expectations, there are some that expect earnings to grow, that even despite the concerns of possible recession and so on and so forth. John Butler, December 9th, 2022, from FactSet, expects that there's going to be positive earnings in 2023, even though there's a possibility of a recession. And this particular gentleman is expecting the S&P to report single-digit earning growth in calendar year 2023. Looks like his expectation is about 5.5%. And then, it doesn't take long to go find another December, also 2022, from Michael Zen, Managing Director of UBS, expect earnings to be in a recession. And that's what he told the CNBC on Squawk Box. So again, expectations, forecasts are abundant.
And again, not to be repetitive, but I am going to be, and this is where I think the year of 2023 is. I mean, this whipsaw year. I mean, you think about some of these stocks that we just mentioned from their lows. Tesla, I mean, it was
Just,
not too
yeah,
long ago, less than 2 months ago, it was at
half price.
$100
Yeah,
a share.
yeah,
Or thereabout, and now it's $206 a share. I mean, those behaviors, that movement in any given stock is not normal. You look at Facebook, right? I mean, these are prolific companies that are, I would argue, very good and strong companies, but that kind of volatility is so extreme. Um, what does the rest of 2023 look like? And how are some of these companies from a stock standpoint are going to respond to this is a great question.
right,
Nobody knows, to your
right.
previous points. So diversification and finding stable blue chip companies and having true diversification, not just among any type of equity, but other asset classes, is critically important now, probably more than in many, many years.
I couldn't agree more. I think the 60-40 model that is quite typical and well accepted had one of its worst performances ever last year. And what do you get when you have two indexes down 25 and 15% respectively? I think it just mandates a little more out of the box thinking, which is what you and I do. No, we've talked a lot about equities, but let's take a second and talk about bonds and fixed income. So we've addressed a couple of times already about the terrible year of the bear market in bonds.
It was a tough year.
I think it's worth noting, and to keep things in perspective, the bond market has never been down 2 years in a row. And the last time it was down was in 1994, and it was a 2.9% drop. So 2.9 versus 13 or 14, between 13 and 14 this last year. We are talking to some of our bond managers, and while they are simultaneously licking their wounds from the performance of the bonds, they're also hungry and buying up everything that they can. Because if today, pick a day, starts day one in the life of a bond, or at least of the time that you own it, you've now purchased something at a lower price. And as the yields are going up, the managers are quite excited about getting a really nice bond portfolio with higher yields and buying them at a good price.
So, kind of closing off on 2022 and tying a nice bow on hopefully what can all be behind us, right, as we look forward.
Yeah.
No one can be certain on how long a bear market will last, but this one, by all indications, it does seem pretty normal, right? So the question for you, Bart, is what does the future hold, and how long will this bear market last?
Yeah, great. Ask me a question that is going to put me on the spot, and everybody's going to say, "You said this." Just kidding. Well, we are at about the length now. We're about 11 months into a bear market, and that is about the average length of bear markets. Some have been a few months longer, some have been a few months shorter. One thing I can say for sure is not every bear market turns into a recession. So you see, I'm not really picking a lane as to whether or not we're going into recession or not. I'm just trying to put out some facts that would say that, hey, it is possible, and it's also possible that we do not. There's certainly forecasts that with the positive growth and with the interest rates that are lightening, the inflation that has been softening, that we could have a positive year on the stock market. I don't want to focus too much on just the stock market, because the way that you and I manage money, it's not just stocks, and we use enough other assets. But I know it's what seems to be near and dear to people's hearts. So,
right. And I think it's important to understand, though, that in a bear market, right, opportunities are created. A little bit of that reset button is hit, and in that there are opportunities that do present themselves, and that's important to be aware of that. And so good things come from corrections and bear markets and opportunities do open up. There's also a number of just global and economic conditions that seem to be coming to an end in sight, i.e., perfect example, the Fed, instead of raising a half or 3/4 of a point, raising a 1/4 point, and saying that it's seemingly so that inflation is starting to wane a bit and start to come down into the realm that we've been targeting and focusing on, and those are good things. If the situation in Ukraine comes to a resolution, that'll obviously have a positive impact. So there's just a number of things that look to be moving in the right direction and heading towards a close, which will have positive impact for sure.
That is a great lead into the next thing I wanted to cover is okay, so we're in a bear market, or at the end of a bear market, what happens next? Statistically speaking, the average return, according to Carson Investment Research, Ned Davis Research, and FactSet, 12 months later, using the S&P 500 after a bear market, so bear market ends 12 months later, is about 30%. So that's average, some higher, some lower. I'm not saying we're done with the bear market, but to your point, Scott, just to really play into that, with everything, with bad stuff comes good opportunities. And I think the opportunities now are, hey, one, and this is, eventually how we're going to end this great chat is, what do we do now? Stick to your plan, trust the process, trust your allocation, and look at opportunities. If the equity portion of your portfolio has reduced, most likely has, as a matter of math and percent, make sure you reallocate, and you will now be buying equities most likely at a lower price, which is going to help to ramp up the return of your portfolio.
Very well said. I think also what you had in 2022 that exacerbated or just added to the performance was, and this is a strategy that you have adopted with many of your clients when a good fit, is tax loss harvesting.
Oh, that's a great point. Mm-hmm.
And so you got to believe that there was a healthy amount of that happening as you headed in towards the end and close of 2022. And then subsequently in the beginning and early parts of 2023, you're probably seeing some of that money move back into various investments. So to not label any one category, but back into the investment category as a whole.
Yeah, and I think the high level takeaway from that is we're all faced with challenges throughout our life, and it's how you respond to those challenges. And in one instance is, if you're dealt lemons, let's try to make some lemonade. And I think looking at a buying opportunity, looking at tax loss harvesting is a great example of that.
The other thing that will subside from an economic and just productivity standpoint is the scarcity of items, supply chain issues. All of those things really reared their ugly head in 2022, and you're seeing signs of progress there. China opening up, you mentioned that early on, that certainly has a positive impact. The issues of semiconductors, companies ramping up and getting the computer components and semiconductors back into supply, and getting these big electronics, be it vehicles all the way down to TVs and probably smaller electronics, moving out of the system, creates supply, reduces cost, helps the overall economy and the overall strength of these companies. So there's just a number of things that all played into this that seem to be smoothening out, if you will, at present time, and should hopefully continue to improve into the future.
Yeah, I couldn't agree more. I think this is a good time to maybe we can get ready to close up, and I've got 5 points that I think people should be aware of as we're going through these times, and something to think about. And kind of starts with the fact that to worry is normal, right? We have things in our lives, and finances is a big part of what we do and how we do it. So to worry is normal, and just acknowledge that It is normal. You're not a strange individual if you're worrying about money, right?
It means you care. If I'm worried about something, I care. I care about that matter, and that's a good thing.
Right. I would say avoid fear-based decisions, right? Emotional decisions very rarely pan out, with positive results. During short, volatility is part of life, and if do not allow it to cause you to make short-term decisions. Rely on your financial plan. Keep on the long-term plan, and that has shown over time to really pay off.
Stay the course.
Matter of fact, thanks for taking point number 2. Stay the course.
have a plan. Follow the plan.
Right, and then these are also connected. And keep your eyes on the end goal. Right. We have met with so many clients, and as we have gone over portfolio results, we've looked at their financial plan, plugged in the results, and in 100% of the case, like, hey, your financial plan still looks great, right? The end in mind. Begin with the end in mind. Connected with that is trust the plan. So these are all, very well connected. But the last one which is something you can do as well, is be mindful of spending. Right? It's during these times, if you spend less, save more, there's opportunities to buy. If you are counting on the income from your portfolio and you can spend less, that's less of a draw on your portfolio. So I think that's a great point as well.
Absolutely.
Well, sir, we did it.
We did it.
Any wise words you would like to add in closing?
The only thing that I would reiterate is that changing economic conditions, cycles are a very healthy thing overall. Markets, companies, leadership are all very resilient, and it's very important. Perfect example, right? You're seeing, instead of the focus of equity companies being focused on top line revenue, which they were for many years when interest rates were zero, money was essentially free. What have they done? The market has essentially told them and forced companies to now focus on profitability and healthy growth. And so what is the result of that? We're seeing companies, as painful as that is, that were bloated and just had an unbalanced balance sheet, an unhealthy balance sheet. They're making those corrections. They're getting rid of workforce. All that to be said, new companies will be born from that. Wonderful opportunities will be created from that. These companies that have significantly experienced adjustments to their stock price, we're seeing the turnaround there, and you're going to continue to see that. Earnings are coming in very strong. So there's just a number of positive indicators that are coming out of all of this. In closing, weather the storm, stay the course, and have a diversified portfolio.
Wise words, my friend. Wise words. All right. Scott, thank you for being a great co-host. Thank you for your participation. Thanks for coming in all the way from Dallas.
Of course.
I want to thank everyone who has tuned in. If you have any questions or would like to talk further, please reach out. In the meantime, I look forward to being back in the studio next week. Cheers.
Welcome to the Zandbergen Report, where wealth strategies and pop culture collide, featuring your distinguished host and certified financial planner, Bart Zandbergen.